Can't do it in your boxer shorts, huh?
Alright, today we're going to talk about applying for a home mortgage, for a residential home mortgage. In years past, it used to be really easy for consumers to go out there and get a home mortgage. If you had a 620 score in comparison to someone with a 720 score or higher, you were treated the same and you would get the same rate and same closing costs typically. But ever since the Fannie Mae and Freddie Mac meltdown and the government bailout, the guidelines have gotten really tight, and it's not as easy for consumers to go out there and get a loan. The best thing a consumer can do is educate themselves before they go out there shopping and trying to get quotes for interest rates. You should know your financial status, know your annual gross income, and include your spouses if applicable. Your base salary and your hourly wage should also be calculated. Know your monthly income. And if there's any bonus income, know that as well. That can also be used in your calculating debt to income ratios if you've been getting a bonus income of 2 years or greater. Also know your assets. You should know what's in your checking and savings account, any assets in a money market or a CD. And you should also be aware of what's in your retirement accounts, anything in your 401ks, IRAs, or deferred comp. What you're trying to do is paint a rosy picture to the lender to make them feel like they have less risk by loaning you the money. Also, you should research your credit history. Obtain a free credit report from any of the 3 credit bureaus, TransUnion, Experian, and Equifax. By doing this, you should find out your credit score and also find out what open accounts are out there and if they're accurate or not. Verify those accounts and any outstanding balances and make sure they match up with what you think or have statements to match up against those. You should also be aware of any credit inquiries that creditors are pulling your credit report and make sure that they were approved by you. Sometimes creditors, if they have your information, will pull your credit report. Well, that can affect your credit scores to drop. The next thing I want to talk about is calculating your debt to income ratios and knowing your loan to value ratios. Your debt to income ratios are your total monthly debt, whatever those minimum payments are, divided by your gross monthly income. Typically, a lender likes to see a debt to income ratio of 45% or less. The lower that percentage is, the less risk it is to the lender and the more likely they are to approve your loan. Once it starts going over 45, there's all kinds of variables that they'll take into account, but it's more likely that they'll deny your loan. Loan to value is basically, it has to do with your equity in your home. If it's a purchase of a home, it's the amount of money that you're going to put down compared to the loan amount size that you're having. So LTV is calculated by your loan amount size divided by the purchase price if you're doing a purchase transaction, or if you're doing a refinance, it would be your loan amount size divided by the the appraised value. The lower the percentages on the LTV, the more likely the lender is to approve your loan. They like to see less risk. Next, I'm going to hand out a loan application just so you get familiar with what a loan application looks like and what's on them. Here's just a copy of page 1. There's 4 to 5 pages. So I'll hand this out to the audience here.
Thank you.
Right here.
Thank you.
So on the loan application, again, it's usually a 4 to 5 page document, which is the guts of the whole loan. But on top of that, there's usually about 16 disclosures that are added to the loan application. I'm just going to cover the first 4 or 5 pages. On page 1, things to look for are the loan amount, the loan program, which is whatever, 30-year fixed, 20-year fixed, or an ARM, which is an adjustable rate mortgage, You want to look for that on page 1. That spells out, how many years the loan is going to be amortized over. The next thing to look for, of course, is the interest rate. Make sure the rate is exactly what the loan officer quoted you. Because sometimes they might tell you something over the phone and find out on the loan application that the rate is higher, or sometimes in some cases it's lower, but you should be aware of where it is on page 1. The other items on page 1 are going to be your name, social security numbers, date of birth, the property address, things of that nature. Pretty much all the fine details of your personal profile and who's applying for the loan. On page 4, the next thing to look for will be the itemization of the details of the transaction. So that'll cover the loan amount size, the closing costs, any prepaid items that need to be paid to the lender when you close the loan, which would be any prepaid interest, and also any escrow accounts if those are being set up. Escrow is an account set up to pay your taxes and insurance at the end of the year. So on that page you want to look for the closing costs. Those items on page 4 will also be found on the initials fees sheet, which is attached to the good faith estimate, and again, that's just another disclosure that's on top of the loan application. Lastly, on the truth in lending statement disclosure, known as the TIL, that is also a disclosure added to the loan application. What you want to look for on there is the truth in, the spot on there that says there is not a prepayment penalty. In years past, people that had risky loans usually had a 2-year to 3-year prepayment penalty where they were not allowed to refinance within 2 to 3 years. So you want to make sure that box is checked off that you do not have a prepayment penalty. So now that you're familiar with the loan application and things that the lenders look for, it's time to go shopping for a rate. The loan process basically is, you shop around with different brokers or retail banks, talk to loan officers, get a rate quote. Depending on who you decide to work with, once you decide on a rate and you want to move forward, they will send you out a loan application like I handed you with all the disclosures, and you will have to fill that out and send back the necessary items along with the signed application in order for the lender to underwrite the file. Once the lender does get the file back, they typically order an appraisal if need be, and that will get scheduled with yourself and sent back to the lender. And once everything's approved and finalized, you'll get it clear to close, and your loan officer will call you to schedule a closing. So in a nutshell, that's what you want to familiarize yourself when you're going to apply for a residential mortgage. Again, shop around. This is the largest investment of your life, so it's wise to shop around and find out who's got the best rates, the best closing costs, and just really get comfortable with the person that you're working with in this transaction. And again, educate yourself and just really know what you're getting into, and just make sure that you know all the fine details of the loan application when it is sent out to you. Any questions?
How do they calculate closing costs for a loan?
Well, closing costs usually add up in the state of Wisconsin at $1,800 typically. So if someone's quoting you closing costs above and beyond that, I would be very sketchy of that. Typically, most places you'll find will give a credit back to keep the closing costs below that $1,800, just to stay competitive in the market and get referrals.
Okay, thank you.
I have a question. If a seller agrees to pay the closing costs of the buyer,
Right.
is there a cap to that, or is that something that would have been in the contract?
It'll be in the offer to purchase contract, typically